Well, guys, do we want to start and just kind of review what we did last Thursday? We're talking about assets, and we're talking about how we show them on the financial statements, and how certain assets, the one asset, land, is never depreciated. All the other assets are going to be depreciated. And we talked about various manners of depreciating assets for generally accepted accounting purposes. We also talked about those items that are added to the asset to come up with a basis in the asset. So for example, when we're dealing with land, we don't just take the purchase price of the land, we're going to take all the costs in purchasing that land, any attorney fees, any deeds or costs related to recording title, commissions, any accrued property taxes, not the current property taxes, but any accrued property taxes that we needed to pay because they were outstanding in the past. So anything we need to do to purchase that land, we're going to include in the cost. Then we went on to talk about other types of assets. We talked about land improvements. Land improvements is a totally separate asset from pure land. Land improvements would include fencing, would include parking lots, light poles, anything that is added to the structure for purposes, but it's going to be depreciated because it's going to wear. So parking lots, driveways, fences, we all know that wears through time, and as a result will be depreciated. But land will not be depreciated. Buildings, we talked about how buildings, the cost of that building is also going to include any cost to help improve it or get it into service, to place it into service. And if we're dealing with the construction of a building, we're going to take all the costs, even utilities, as that building is being built, to add to our basis on the building for depreciation. For equipment, we're going to take the sales tax, freight to get it there, any insurance while in transit, not once we have it and it's in service. That insurance would be a separate issue. But all costs to modify it to the condition that we want it, all gets included in the basis. We also began talking about salvage value. Salvage value is the amount after we've used up the asset, what is left, what we will be able to sell or get rid of this asset for. So salvage value is the asset's value at the end of its life. So when we depreciate, we're going to take all the cost, subtract from it the salvage value for straight line, and we would depreciate that over a certain time frame. That's straight line. Then we started talking about various methods, declining balance, where we accelerate that depreciation up front because this asset is going to have a greater wear and tear at the beginning of the period versus at the end. Another example we talked about with double declining method is we depreciate it heavily up front because then in the later years our maintenance expense will come into play at a greater cost and offset that depreciation. So we compared the various rates of the straight line, and as you can see with straight line, it's the same amount each year, and the book value goes down based on the amount we're showing as the depreciation expense. It gets added to our accumulated depreciation, and it's a straight amount. In the last period when we use straight line, you can see here, if we put this in service on April 1st, we're only going to take 9/12 of the year, that first period. So in the last period, we're only going to take 3 months. We'll go through problems like this. Accelerated method of double declining, basically what we do is we double it. So if we have a beginning book value of $13,000, our double declining rate is going to be twice the straight line rate, or 40%. So then what we do is we subtract the depreciation we're taking from the book value, and then in the next year we're going to take our book value, not the original basis, but the book value times 40%, and again come up with a new book value at the end of the period, and continue doing that until we hit the salvage value. Now, as you can see here, in year 5, the 40% of the book value would be greater. It would be 40% of 1685 would be about, say, 700. But we're only going to take 685 because we want the salvage value to be at $1,000. Now, I don't think, we did start talking about units of activity. So there are certain, like automobiles, they generally have a useful life in miles. So we can allocate how many miles we went on a truck per se based on it, the useful life, and calculate a rate per mile or a rate per hour to calculate our depreciation. There are various methods. The key for this chapter is to understand the methods, when they might be used, and to see on this chart here how the various methods compare. Straight line method stays consistent throughout. The units of activity method are going to vary based on the activity, and the double declining method is extremely high and tapers off significantly as the asset ages. Now, for income tax purposes, we don't have to use these same methods that we use for book or GAAP purposes. There are straight line methods when we're dealing with buildings and amortization, but there's a method called MACRS, or Modified Accelerated Cost Recovery System, we use for most assets. Yes?
How come we have to learn this stuff that's not acceptable for GAAP? Like the write-off method, you said you can't use that for GAAP, right? So why do we have to learn it?
Because it's used for tax purposes.
Oh, okay.
So sometimes things are used for one but not used for another because tax allows it.
Okay.
So a lot of times with businesses, you're going to present your financial statements for the tax purposes, what's most beneficial, which gives you the lowest tax rate. Now, let's just say that the depreciation method we find out changes. Either we realize the asset has a greater useful life, or maybe not a greater useful life. We are not going to go back and change back periods, but we're going to change future periods once we're aware of the change. So that period in which there's change, we're going to adjust and move forward. You don't go backwards. Arcadia purchased equipment of $510,000, estimated to have a useful life of 10 years with a salvage value of $10,000. Depreciation's been recorded for 7 years on the straight line basis, but in year 8, all of a sudden we realize the estimated life should be 15 years and the salvage value should be 5. So what we've done prior is going to be fine. We will have already depreciated 7 years at $50,000 a year, or $350,000, and moving forward we'll then make the adjustments. So to correct prior year's depreciation, there's nothing we're going to do, but going forward we're going to change it. So the way we're going to change it, we're showing now that the salvage value is $10,000, and the original life was going to be $50,000 a year, depreciation $50,000 at 7 years. And the original salvage value was $10,000. So currently, with an asset of $510,000 and our depreciation of $350,000, our new adjusted basis or net book value is at $160,000. So now going forward, we think we have our new salvage value instead of being $10,000 is $5,000. So we've got this base of $155,000 that now we're going to depreciate over 8 years because we finished year 7, we're in year 8 out of a 10-year depreciation. Now we realize it can be depreciated over 15 years, which gives us 8 more years here. So we're changing our depreciation from $50,000 a year to now $19,375. So do you see, we don't fix anything from the past, we just go forward and create a new depreciation. When we're dealing with maintaining equipment, that is going to be an expense. It's going to be considered a repair. But when we're doing things to improve the life of an asset or its capacity, we're going to treat it as an asset or improvements. There are times that the asset doesn't have the value at one time we thought it had. If an asset is impaired for a certain purpose, then we might have to show the asset to be written down. Let's say we have a building, and the building had fire, and we showed this asset to be $1 million. But after the fire, we realized that this new asset, this asset isn't worth $1 million anymore. It's worth $200,000. Whenever we have a form of an impairment, we're going to write that down in the current period because we don't want to overstate our assets, right? We want the assets to be as true to value as possible. What happens when we get rid of assets? So there's going to be times when we get rid of a building or we get rid of a truck, and we may sell it or we may just purely get rid of it, trash it. So there are times we need to show the disposal, the gain or the loss on the sale or the removal of assets. Sometimes they're retired, sometimes we sell them, or sometimes we exchange them for other assets. How many of you guys, when you've purchased an automobile, trade in an automobile for another one?
Yeah, my mom has.
So in some respect, that's an exchange and probably involves some cash, but there's an exchange in that asset. So we're going to talk about manners and methods in disposing of assets. Okay, so let's look at this. When we sell an asset, we're going to take the book value of the asset, which means with the adjusted basis, with all the accumulated depreciation reduced. And if the proceeds that we are selling it for are greater than the book value, we're going to have a gain. But if the proceeds are less than the book value, what's going to happen? We're going to have a loss. On July 1st, Wright Company sells office furniture for $16,000. The office furniture originally cost $60,000. As of January 1st, it had accumulated depreciation of $41,000. Depreciation for the first 6 months of 2014 is $8,000. Prepare the journal entry to record depreciation expense up to the date of sale. So we're going to sell office furniture. It originally was purchased for $60,000. We have accumulated depreciation of $41,000 as of January 1st. So depreciation for the first 6 months is $8,000. what is our journal entry going to be to record the first 6 months of depreciation? Anyone? Will it be depreciation of 8, accumulated depreciation of 8? Now, what happens is we're showing all the accumulated depreciation we've taken on this asset. We bought it for 60. We have accumulated depreciation of 49,000, which means our new book value is at 11. But if we sell it for 16, do we have a gain or do we have a loss? We have a gain. So we need to show getting this asset off our books too. We need to remove the asset. So to remove the asset, we're going to do the opposite the normal balances. Equipment has a normal debit balance, doesn't it? But to get it off the books, we're going to credit it to zero it out. Make sense? Accumulated depreciation has a normal credit balance because it's a contra account. We're going to get it off our books by debiting it. Then the difference we're going to show as a gain. The beauty with double interest system is it always has to balance, right? It's got to balance. So we show our cash we get in, we zero out the equipment and the accumulated depreciation, and we automatically know then we're going to have a gain. It's like a revenue of $5,000. Any questions on this so far? Do you guys want to take a minute and go through a problem like this? Should we do that?
Yes. Do it.
Okay, so let's look at what page are our problems on? Let's look at exercise 9-8, okay? Here are selected 2014 transactions of Cleveland Corporation. January 1st, retired a piece of machinery that was purchased on January 1st of 2004. The machine cost $62,000 and had a useful life of 10 years with no salvage value. What we're going to do here is journalize all these transactions to show how we are going to dispose of them, okay? So, we depreciated, or we bought this machinery in January of 2004. It cost $62,000, and there's no salvage value. So if we bought it in January of 2004, how many years of depreciation have we taken on this building? Or on this machine? How many years, guys?
10.
Have we taken 10 years? Everyone agree we've taken 10 years of depreciation?
Yep.
So what would be the new basis of this machinery? It had no salvage value.
So it would be 0?
It would be 0. So how are we going to take this off our books? What do you think we're going to do, guys?
Straight line
Depreciation expense?
the depreciation expenses already happened. So we're going to want to get it off our books. We're going to want to get the equipment off our books, and we're going to want to get the accumulated depreciation off our books. So how are we going to do that?
Credit equipment,
Credit equipment for how much?
62,000.
And what are we going to debit? Accumulated depreciation for 62,000. Do we have a gain? Do we have a loss? Did any cash exchange hands? No, that's pretty easy, isn't it, guys?
Yeah.
Now let's look at the next one. Here, let me get in here so I can show you how we would do it. So in that scenario, we would have a journal entry of accumulated depreciation of how much? 68?
2.
That's too big.
Little too big there. And then we would zero out our equipment of 62,000. And all we would say here is that is to remove equipment, to retire equipment. How about that? Okay? Okay, the next one shows sold a computer that was purchased on January 1st, 2012. The computer cost $36,000 and had a useful life of 3 years with no salvage value. So the computer was sold for $5,000 cash. So what's the first thing we're thinking we need to do? We need to figure out how much depreciation we've taken, don't we? How much depreciation require all entries required on the above date? Journalize all entries required on the above dates, including entries to update depreciation on assets disposed of. So sold a computer that was purchased on January 1st, 2012. So we sold it 2.5 years later, correct? The computer cost $36,000 and had a useful life of 3 years. The computer was sold for $5,000 cash. What would be the depreciation we took on January 12th in the first year? $12,000. What did we take the second year? $12,000. So we now need to record the journal entry up to June 30th of this year. So what are we going to show the depreciation to be for this year?
$6,000.
$6,000. The first thing we're going to do, June 30th, the first thing we're going to do is show depreciation expense of $6,000 and accumulated depreciation on the equipment, $6,000. Okay? That's the first step. Now we want to get it off our books and record the sale of equipment. So the next thing we're going to do is we need to get the accumulated depreciation off of our books. So the accumulated depreciation on the equipment has been 12 plus 12 plus 6, right? Or 30,000. How much was the cash we received?
5,000.
5,000. What did the equipment originally cost? 36,000. Do we have a gain or do we have a loss on this equipment? We have a loss, don't we? We have loss on disposal of plant assets of 1,000. So again, to make our journal entry balance, we're showing we have a loss. The other way we know we have a loss is our equipment was 36,000. We've taken depreciation of 30,000, which means we have a $6,000 adjusted basis. But what did we sell it for? 5,000. So 5,000 sale minus an adjusted basis of 6,000 is a loss of 1,000. Make sense, guys? How you doing?
But how come it says it has no salvage value?
Because it's letting us know that when we did the depreciation, that we don't need to, we're not going to get anything for it when we dispose of it.
Okay.
Usually with computers, really they're not worth anything. So how many of you guys want to buy my 2004 Dell for $1,000? How many can I give it to? Do you even want it? Do you see what I'm saying? Certain things have value just because of scrap, but usually computers don't, just because the microprocessors, everything's changed. Okay? Any questions on that? Good question though, Martin. Anybody else? Okay. Let's go back to the second part, the last part of this problem. Sold a delivery truck for $9,000 cash. The truck cost $25,000 when it was purchased on January 1st, 2011, and was depreciated based on a 5-year useful life with a $4,000 salvage value. So we purchased it in 2011, now we're in 2014. So how many years have we depreciated it for? How many years? What? 2011, 12, 13, and 14, because this is December 31st, right? So we depreciated it for 4 years. How much depreciation did we take? What did we purchase it for?
25.
What is the salvage value? 4,000. So we would depreciate, the depreciation basis is at 21,000, right? And we've got, so we're basically going to depreciate 4,200 a year, aren't we?
Mm-hmm.
So far, we've depreciated 4 years at 4,200, right? Is that right? But we need to show the depreciation on December 31st. It wants us to do that. So our depreciation that we're going to show on this equipment for this year, for 2014, so we're going to show depreciation expense of how much? How much is our depreciation?
Like total?
4,200 for just this year. And our accumulated depreciation is 4,200. Now, we're going to show the sale of this, this asset. So, how much depreciation have we taken in total?
20.
We've taken 11, 12, 13, and 14. So we're taking 4 years out of 5 years. Okay? So 21,000 would be what it would show if we had depreciated off 5 years. So right now we've taken how much depreciation? 4,200 times 4 years is what, guys?
16,800.
Right. So our accumulated depreciation is 16,800. It's basically 4,200 times 4 years, right? Right? And then, so we're going to do our accumulated depreciation, clean that off the books of 16,800. How much cash did we receive? What does it say our cash is? Somebody.
9,000.
9,000. We received cash of 9,000. How much was the original price of the equipment? Equipment of 25. So are we going to have a gain here or are we going to have a loss? We're going to have a gain of how much? 800. Gain on disposal of asset, 800. How many of you guys get this? Get what we're doing? Okay, great.
How do you know whether to credit or debit the gain on disposal?
A gain will always be a credit
Okay.
and a loss will always be a debit. So the reason we know there's a gain, let's take our 25,000, the equipment, subtract from it 16,800, gives us a new basis of what? 8,200, right? But how much did we get for it? 9,000. So do you see how we know it's an $800 gain? We received more for it than our adjusted basis. Okay? How's everyone doing?
Good.
Great. Do you guys want a break right now?
Yeah.
Why don't we take